Good morning, everybody. We've got Wealth Without Wall Street here today, and I'm excited about this, and I know y'all are too. I put out a post about 30 minutes ago discussing the topic of infinite baking today, and the amount of response I got out of that was amazing. So for those of you that have ever heard of this concept or have never heard of this concept, we will be discussing this in depth today with these two wonderful people over here. Can y'all give us a little bit of information about Wealth Without Wall Street and a little bit about your background and who y'all are?
Yeah, I'll lead off. So my name's Joey Murray. On our podcast, I'm known as the Italian Stallion. So that should tell you a little bit about my background. No, I was not in the mob, and not currently, but yeah, I actually learned about all this sort of stuff from Russ. Russ was my coach back in the day. In 2010, I learned about this while I was in the mortgage business. And so I wasn't directly in real estate, but all my best friends were in real estate. And so I learned about this from that perspective. And ultimately, what it boiled down to was I was looking for a way to save money in a way that I could continue to access that money to get to financial freedom. And all the traditional ways of thinking, 401ks, IRAs, 529 plans for my kids' college savings, and all those things just left me wanting more. And so anyways, dove into this process in 2010. And 4 years later, I looked up and my family was in such a different position financially that I was like, man, more people need to know this. And I said, Russ, I think I'm going to come join you and do this as a team. And he was like, are you serious? You really want to do that right now? So I gave up a career making well over $300,000 a year. My wife was pregnant with our fourth daughter, which Daniel, I know you've got your daughters, and I'm sitting here with now 5. But
Wow.
you can imagine, talking to your wife, and she's pregnant with number 4, saying, "Hey, by the way, we're going to go to $0. I'm going to start a business from scratch with Russ." And you imagine her first words to me were, "I think you should do it," because she knew how exciting this was and how it had made a big change for us. So that's how we got here. We started Wealth Without Wall Street in 2016, and just been able to impact lives all over the country.
That's awesome. That's awesome.
Uh,
So,
so Joey, as he said, basically I was his hero, Daniel, or the instigator to his entrepreneurial journey. I don't know. But my background starts from a financial perspective. I actually was a typical financial advisor, actually became a certified financial planner. And really quickly after the '08 crash, I realized I was nothing more than a glorified money babysitter that didn't have much education outside of what I had experienced, which was brief in a rising market and then an immediate crash. And what that did for me is it gave me motivation to go become experienced and knowledgeable in other things, in other areas. And to when I went on that path, the more exposure I got, the more I looked around, I saw the people who were being successful were people who are investing in themselves and were controlling their future instead of letting someone else control it for them. Joey likes to say abdicating that responsibility to others. And I really quickly knew that I couldn't be a hindrance for people any further. I couldn't continue to be the one that people gave money to and pretended like I was going to have all the answers and I was going to help them while they went back and, went back to work and their 9 to 5 and then we're expecting at retirement that their money was going to magically be enough for them to retire on, when I knew good and well that the game that I was playing in was rigged and it was not rigged for them. And so that journey led me through a lot of different things, but ultimately it led Joey and I to starting Wealth Without Wall Street. And thankfully through a podcast, it's exposed us even further to new information and new insight, and ultimately to being introduced to you and being on this show. So thanks for having us today.
well, I appreciate that. Now, I'm gonna sit here and ask you probably one of the most common questions you get all of the time. What do you mean by wealth without Wall Street? If that didn't make sense on its own.
Yeah. Well, Wealth Without Wall Street, we first start off with that concept is it's a mindset. And of course, everybody would resonate with Wall Street. Just they would think stocks, bonds, mutual funds, 401k investing, things like that. That's where a lot of people will start, but we will try to even take it further than that. We would say that when we want to build wealth, we need to build it on our own terms and not on the terms that have been marketed to us for, going on almost 40 years now. We need to go back and dig on things that have been around for a long time. You wanted to say something?
No, I love that. I mean, I love the fact that you've pointed out one of the things that I consider to be detrimental to us, and that is we have been fed information that profits others and doesn't really profit ourselves. I think we have been trained to think that we're not smart enough to manage our own money and that we should put that money into other people's hands. And I really like the fact that you're openly speaking on breaking that mold, which I believe is a very important part to advancing our society as a whole.
Yeah, that's right. I mean, the thing that's holding us back is lack of knowledge, right? I mean, once we're educated, then we're really truly free because we can do lots of things.
Which that's why we love Propelio, because you've actually taken that stance as well and said, man, if people could just have exposure to the right information, they would be foolish not to invest in themselves and into their own own means of building wealth and cash flow ultimately, and not continuing to buy that, that they can't do it and that they need somebody else to do it for them. I mean, if we really break it down, the barriers, and you think about it, I mean, it would be like, who is going to care for your money better than you? Nobody. Nobody is going to benefit. They're not going to think about it from the best standpoint of you, rather than yourself. It's kind of like leaving your kids with a babysitter all the time and thinking that's better off for them.
Right.
Never. It's never going to work. So anyway, that's kind of the basis.
I'm really excited about this because I believe y'all's mission and the one that Propelio is on is very much in line with each other, and I'm very excited about opening up this new concept to many of the people that are out there listening right now. I know whenever I put out a pre-post on this, and in a very, very short period of time, it started racking up a lot of information on it. So let's kind of open up. Can you explain on a high level what are we referring to when we talk about infinite banking, and what does that mean to y'all?
I'm sorry, will you repeat that? You broke up right as you said, what is this? And then it went blank, and I was like, okay, I could really elaborate on a lot of things.
Fill in the blank.
What is infinite banking?
Okay, perfect. So infinite banking, and I will come back, if it's all right, down the road and talk about how we get to infinite banking. But on a high level, infinite banking is a process of understanding that our money has a cost and that we need to use our money wisely in all things that we do. So our mentor, a man named Nelson Nash, he passed away last year. He wrote a book called Becoming Your Own Banker. And he was always telling us, Russ, Joey, banking is. It says it doesn't matter if you use your cash and give up access to the earnings on that cash from that point forward. If you use someone else's cash and you pay them interest, banking is. The process of banking has to happen. It's a transaction. It's a flow of money.
Okay.
And he said, who is going to control that function in your life? And he went on to write a book that kind of detailed a couple things. One that we always like to separate, there's a tool. That tool is a dividend-paying whole life insurance policy. And then there's a process, which is the function of using that tool to influence and improve the things that you're going to do with money, whether that's buying assets and creating cash flows, whether that's buying expenses and mitigating liabilities, whatever it is. Infinite banking is the process, and then there's a tool that goes along with it. And so today, if you want to, we can break down both of those and how they work together.
Yeah, I'd absolutely love to. And some of the things that I kind of extracted from that real quick was that you were using a dividend-paying whole life insurance policy coupled with another tool, and then you were using that to essentially create your own transactions. Am I following that correctly, or did I miss something?
Yeah, so the whole life insurance policy is the tool,
Okay.
And then the process is actually infinite banking, which is basically velocity of money. It's putting money in motion. It's the thought of collateralizing an asset. For some people, it's second nature. You're already doing it. You're already using a credit line as the process, right? Maybe you use equity in a house that you have as the collateral, and then you get a credit line against it, and then you're just turning money over and you keep the asset working. Well, for infinite banking purposes, we typically use the asset as cash value life insurance and do the same credit line process.
And it would go in line with what we're talking about. The cash flow in an asset that has to do with real estate. So the process is just replacing the tool. The whole life policy tool is replacing what would be your normal cash accumulation method, whether it's through a checking account, savings account, or using a bank like a line of credit like Russ was just talking about. You're replacing that with your own policies or policies to obtain that portfolio of real estate.
Okay. Let me see if I can jump in here and recap on this, because there's a couple of things that you said that the average person may have not caught on to, because we are speaking a new language now. Some of the terms and some of the words that y'all may be using are terms and words that are not on the average person's vocabulary. You're using words like collateralize and stuff like that. Now, if I'm a newer real estate investor, or I'm a newer investor in general, I might not necessarily understand what you mean by that. So when you're saying collateralize, are you saying like, I am going to borrow or do something like that, and I'm going to put something else up in exchange for in case I don't pay you back? So like whenever we go out and buy a house, the house is the collateral. You've loaned me money, and if I don't pay you back the money, you get back the house. That's a very common collateralized transaction. Other ones might be giving, you get a car, and you borrow money for a car. Well, the car is the collateral. What I'm gathering you're saying here is that one of the things that might be able to be done is that I can use a whole life insurance policy, something that has a cash value to it, and I can use that whole life insurance policy as collateral to borrow against. Is that the way you're saying this?
Exactly. So think about one of the first examples somebody shared with me, Daniel, is they said, imagine when your little girl grows up and she's ready to go buy a car. Now, this was years ago, and my little girl turns 15 here next month. So this is about to become a reality, right? Because we're going to be buying her car pretty soon to help her prepare for 16, right? I want her to know the car and be comfortable with it before I send her off on her own. But they said, Russ, imagine that you walk into the bank that you've been doing business for years with, right? You've been a good commercial customer for them as well as a good personal client for them. You walk in there hand in hand with your daughter. Once she turns 16, she's buying her car, or in my situation, we'll probably get it sometime halfway through her 15th year. And, you're walking there with her to get the car. And let's just assume, in this situation that she has a little job. And so she could potentially qualify as the co-borrower, or in some people's situation, this is later in life and the kid's coming out of college. Whatever the case is, you're walking in there, you're going into the bank, and there the banker sits down to draw up the loan documents for the car that they're buying. And they say, yep, okay, you guys qualify for this, your job, everything, will pay for it. Here's what you need to have in order to go buy your car. And then you're walking out the door just smiling, your daughter's smiling, everybody's happy because you just saw your daughter grow up right in front of you, qualify for her first loan. And he said, but if you really panned back and you looked at the banker, he'd had the biggest smile of all. Now, why do you think he'd had the biggest smile?
More than likely because he was about to get a loan done.
Yeah, he got a loan done, so he just probably made that helped him out, whether he was commission based,
hit his quota,
or hit a quota, whatever it may be. But the reality is that whose money did the banker lend?
Likely your own money right back to you on a fractional reserve.
Exactly.
Bang. Exactly.
He lent the money that I've been putting on deposit, either in my personal lines or my commercial, in my business accounts, straight to my daughter. And who gets to keep the juice in between?
Well, the bank does, and I think
The
that's something
bank
most people
does,
don't
right?
realize.
Yeah. And so for what we're going to be talking about is we're going to show people how that they can be both a depositor, a borrower, and they can also be a participant in the profits. And so this is a really, it's a simple concept. We use it all the time in life. We just don't think about it. Maybe we're not getting to participate in all the functions. A lot of times we go to the bank as a depositor. We have loans against at the same bank, but yet we're not an owner of the bank. So we don't participate in those profits. But
Okay.
what we teach people is that there's a way to be in all three positions. And it's a process that starts to simplify life. And as you were on our show not too long ago, we were talking about, the pandemic and where we are in potentially the real estate business cycle, is we need to be moving to a position of liquidity. And for us, we want to be liquid. And this is a great tool to help us do that as well.
Awesome. Well, I'm excited about this. So for those that are in here watching, I'm gonna start asking some questions, and let's see if we can really break this concept down to actionable steps. And for anybody that doesn't know, these guys have have a wealth of information on their website. What's your website, guys?
Yeah, we're at wealthwithoutwallstreet.com. And I think you may be talking about like the community aspect.
Yes, sir.
We have a separate app that you can go in, and we have a ton more information there. But you can get access there at community.wealthwithoutwallstreet, or just in the App Store, search for Wealth Without Wall Street.
Okay, so make sure you'll go out there and download his app, and because there's actionable educational videos on there that y'all can watch and figure out some more about this. But I've got some questions to really ask, because I'm relatively ignorant on this, and I know I had Marshall Hooper ask a question. I'm going to warn y'all guys, this guy is really smart, far smarter than I'll ever be. But he asked a question I don't even understand the answer to. He says, "Are they talking about direct and indirect recognition?"
All right. Well, so that's a great question, and I want to answer that, but I want to put this in context. And what you just said leading up to that question made me think about this thought. So for everyone listening to this right now, I want you, if you have a pen out, I want you to, assuming you're not driving, right, running on the treadmill, you're just sitting in front of the computer, take your pen out, put a piece of paper in front of you, and just make a dot on your piece of paper with your pen. Now, obviously, that's a really small amount of information, right? Well, I was exposed to this thought process one time. I'm going to use this analogy, and then we'll break out Marshall's question. So when you do that, you have a really small dot. Imagine that represents all the knowledge, whether that's all the knowledge in this one subject matter, all the knowledge you have in all subject matters. And more importantly, what you don't know that you don't know is bordering that circled area. Well, see, that's a really small circumference too, right? But then if you took out a coin out of your pocket and you put it over the top of that dot and drew a circle around the edge of that coin, now what's happened is that inside of that circle represents the knowledge that you have. But really, if you think about it, everything bordering the circumference of that circle now represents all the knowledge you don't have that you don't know. Now you take a coaster off the table and you draw a circle around that. You follow me? What's happening is the more knowledge we get, the more we know we're exposed to things that we don't know. So I'm gonna say that whether you're coming to this conversation cold and have never heard the words IBC outside of a root beer, right? and that's not what we're talking about, even though I love a good root beer. It doesn't matter where you're coming at in this conversation, because there continues to be information that you don't know. And that's because the concept starts with the word infinite. And Nelson Nash, as he died last year, had been doing this for over 50 years. And he was being exposed to things that he didn't know every single day. And I think we're called to be learning individuals. And so Joey and I are going to sit here and tell you, Daniel, that we've been studying this thoroughly since 2008, 2009. And we are we're still on our learning path, right? So I listen to other podcasts on this regularly. I read books on this. I go back to Becoming Your Own Banker.
Yeah.
We get up and talk at a lot of conferences and share, but we do this from a perspective of, yes, we've learned a lot, but there's still a lot to learn. So Marshall's question is a question that the circle would be, he's 2 or 3 layers deep, right? So his question is pertaining to the way insurance companies work. So I'm gonna break it out in this way. There's 2 different types of insurance companies. There's a mutual insurance company and there's a stock insurance company. Now, the word stock got to tell you a little bit about the way it pays out its profits. Pays out profits to stockholders. So these would be companies like AIG, right? John Hancock, companies that you could go find on an exchange and invest in. Then there's mutual insurance companies, and these would operate a lot like your local credit union, meaning that they're owned by the depositors. In insurance company language, they're owned by policyholders. Now, Joey and I only operate in the business of mutual life insurance companies.
I bet you wouldn't know that because we don't like the word stocks, right?
Exactly. So I'm going to take that and expand that out even further. So now within mutual insurance companies take in what's called premiums. Those are really just deposits, monies that are taken in order to run their operation. There's really 3 things that they're looking for. They're looking for the cost of insurance, right? So they look out over the last 100 years and determine how long, does someone live? What's the pattern of deaths over 1,000 lives when you meet a certain category? Then they're looking at administrative expenses. So what does it cost us to run all our business, salaries, like
overhead,
all the stuff that we already know as business owners. And then secondly, they have to put that money to work somewhere. Insurance companies are big in bonds. They're huge bond holders. 90-something% of their portfolios held in bonds. They do hold commercial real estate as a part of that function, and usually less than 1% is ever in stocks or any equities or anything like that. All right, so they take those 3 criteria and they have to determine how much premiums do they need to take in for a given policyholder. So I'm going to use you, Daniel. Let's say they take your age, they take your health, and they say, okay, you want $1 million of life insurance. It's going to cost $1,000 to provide this to Daniel's family.
Okay.
But these guys are engineers. They have engineers called actuaries that work in these insurance companies, and they say, hey, we can't charge $1,000 because you know what? Just like all engineers, they need to put a red line on there and say, let's make people slow down here and not go. And so when they do that, they put a little fudge factor in there. So really they say, instead of charging $1,000 for this, let's charge $1,050. Well, like all good engineers, they've over engineered the product. So at the end of the year, there's money left over, right? It only cost actually $950 to provide $1 million worth of coverage to you and your family. So now they got $100 to do something with. That is what's called a surplus. Some of that money they're going to put back in a contingency reserve just in case next time their calculations were a little off.
Okay.
The rest of it is going to come back in the form of a return of premium, but they use the word dividend. Now, for us who's ever invested in stocks, we think dividend, we think IRS, right? We start thinking about profit and taxability and congratulations, your business made a profit, now pay us some tax on it, right? Well, for insurance companies, because they overcharge for it, there's no taxability on that dividend because all it is really giving you your money back. Best example I would give you to that analogy is if you go in the gas station to buy a candy bar, the candy bar is 85 cents. You give them $1, and when they give you the 15 cents back, do you have to pay tax on the 15 cents?
No, sir.
No, it's just return of your capital. It's just return of your overpayment for it. Well, I go to all that extent to answer Marshall's question. Okay, I wanted to make sure I gave some framework. So
you gotta have some context.
So hopefully, I'm helping other people along the way get to where Marshall has gotten to. So now, when they send back that, I'm going to say out of the $100, they gave back $75, and they called that a dividend. Some insurance companies look at the policies that are outstanding and they say, well, are there any loans outstanding? And if there is a loan outstanding, then we may reduce that $75 because they had a loan outstanding. And that would be what's called a direct recognition company. And then there's other insurance companies that when they get ready to send out the $75, they don't look to see if you have a loan outstanding or not. They just send back the $75. Those are called non-direct recognition companies. So for our discussion today, we probably won't go much deeper than that, but there are two different types of ways insurance companies evaluate whether or not you have a loan or not. And be honest with you, I own 21 different whole life policies, and I have probably 5 policies that are direct recognition, and then 16 policies are non-direct recognition.
Okay. So I need to pause for a second because I may have misheard what you just said. And I've got a couple questions coming in. I got one from Kimberly that I'd like to answer for you. But
yeah.
Were my ears messing with me when you said you have 21 life insurance policies?
I got 21 whole life insurance policies. Yeah, I have other life insurance policies, but 21 whole life insurance policies.
So that is very intriguing to me, man. We are already close to 26 minutes into this, and I know I've personally got a ton of questions that I'd like to ask y'all, but I got one here from Kimberly, and she says, after you borrow against your own policy and buy a real estate asset, when you make a profit on your investment, can you put that money back into the policy?
That is a great question. And really, Kimberly, you're already getting the process of infinite banking, because again, it would be no different than if you're using cash to buy that asset, right? If I take cash, I buy that real estate asset, and I have done a good job, that means I bought an asset that is actually creating cash flow, then that cash flow has to go somewhere. And what's going to happen? Historically, you just put that money back into a checking account or whatever it may be, and you start to then accumulate towards the next asset that you're going to do. The same is true with your whole life policy. I'm going to take a loan against my cash value, and that loan comes from the insurance company, okay? So that money is no longer, it's not my money. That allows my money to continue to grow uninterrupted. I'm using words very specifically because I want you to understand the power of infinite banking is over a long period of time, I'm allowing my money to continue to grow uninterrupted. Compare that to the checking account example. I can use that cash in my checking account, and what do I have to do in order to buy that real estate asset is I have to remove it from the bank, right? Okay. It's not that I can take anything against it. I literally am taking money out of the position of earning any sort of interest, which, by the way, a checking account is earning a laughable 0.1% or whatever anyway, so we don't even recognize it, right? But I take that money out. I have to physically remove it. And so the beauty of this process is I'm borrowing against my money, so my money continues to grow. I buy the asset, and then I return all that cash flow back into the policy to repay that loan so that I can use it over and over again to continue that process.
Can I jump in real quickly just to use an example? Because
please.
Joey and I love to draw, and for those who are listening to us, sometimes it's hard to follow when you're not seeing Joey's conceptual example. So if it's all right, I'm going to use numbers. It was Kimberly, right? So yeah. Let's assume, Kimberly, I just take one of my 21 life insurance policies. And for round numbers, let's say I have $100,000 of cash value in it. Now, cash value is the same as cash in your checking account. The insurance company call it cash value, but it's just liquid cash. I can take a loan against it, or I can take a withdrawal from it. That's my two options. So let's say I took a loan, because that's what you asked. So what I do is I go to the insurance company and I say, okay, I'm going to use that $100,000. And I go, okay, I want you to deposit it into this account, my real estate investment account. And so they send a check of $100,000, and now it's in my real estate account. So I have $100,000 of cash value still, as Joey was saying, and I also have a lien of 100,000 against that cash value. And I also have 100,000 now in my real estate investment account. So you see what we just did.
Can I pause?
We now have $200,000, 100 in my real estate investment account and 100,000 in my cash value, and I have a $100,000 lien in the middle. So when you take that 100,000 in your real estate account and you go buy a property, let's just say it's a fix and flip, and you turn around in the next 3 to 6 months and now you have 150,000. Your question is, what can I do with that 150? Well, we're going to go back to the insurance company and we can pay them back the 100 that they loaned us to begin with. We also are going to pay them probably about $2,500 in interest, because that note we had against it was a interest only note with no payments required. But so if we paid them nothing over that 6 month period of time, now we got to pay them $2,500
for the use of it.
For the use of it.
Yeah.
Now we have $47,500 extra. And your question is, well, can I put that in that insurance policy? And the answer is maybe. It depends on how we structured it. But in some situations, we may have started that initial policy where I was putting in the premiums that got that 100,000 built up, and I still have money to put in it. So I don't have any more room in that policy. And so this is where you're going to start to have that aha moment. Oh, this is why Russ has 21 policies.
Exactly.
Because every time I've done that transaction and I started creating extra cash on the side, I needed a place for it to go, right? Okay. And therein lies where I start buying new insurance policies to put that cash. And then I start multiplying these policies together and I start doing the same function. Maybe I take a loan against 2 policies the next time instead of 1. Or in some situations, 5 or 10 or whatever, how big, you're going to go buy an apartment complex. Maybe I need $1 million. So maybe I need to go to 10 of my policies and get 100,000 out against each one of them. And does that answer the question?
I believe it does. And I know Joey had something he was going to follow up on there, but I've got a couple more questions that came out of the answer.
Yeah, go for it.
So you've got $100,000 on the insurance policy, cash value. You borrow against that and you put a lien against the 100K, right?
Yeah,
that's right.
Okay. That lien and that note, who is the beneficiary of that note? Who created the note? Who's getting the interest on that note? Is that you or is that the insurance company?
So the insurance company is lending you their money against the collateral of your policy, right?
Okay.
So that 100,000 is they're going to benefit from the interest of that. And as Russ mentioned, it's going to be generally the companies we work with are 4 to 5%.
Okay.
5% is the most common.
And that goes back to, remember when I said the insurance company, they're going to take in premium dollars, they're going to factor in insurance costs, they're going to factor in administrative costs, and then they've got to put it to work. Well, one of the places that an insurance company can and does put their money to work is back to the policyholders, lending them the money, which you might imagine is the safest investment an insurance company makes.
Right.
Because it constantly reduces their risk. Because here's the benefit of that. When they lend you that money, it reduces the amount of the death benefit on that policy by the equal amount, which is really ultimately their liability to you, right? So that's why this is not magic. I think one of the things about infinite banking that can sometimes be this like mysterious, like look into this mysterious box of infinite banking and magic comes out of it. Like, no, that's not the case. Like, this is a business transaction that is good for the insurance company and it's fantastic for you. So if it wasn't a win-win, we should never be engaging in it, right? Because it's going to be short-lived at best if it's the case. So anyways, I'm not sure if that answered the question completely, but I wanted to give a little bit of insight there.
I think the way I'm looking at it now is that this is an asset-based loan. The asset is the money that you've already got on deposit with them, and they're just loaning you against the money you've already got on deposit with them. So you get to leave your money there. They loan the money back to you at a low interest rate. Like, I don't know what the terms are on average. Are they like a infinite loan, like a 30-year loan, 10-year loan, 6-month loan? I don't really know how that works.
Yeah, it's unstructured. It's interest only, unstructured. So there is no terms to it. So that's the beauty of why our real estate investors love it, especially if they're if they're maybe doing fix and flip or other models that may not be providing cash flow immediately, it gives you that flexibility as a business owner not to have to come up with the cost for the money.
I'm excited about that. So for all of those watching right now that are heavy on real estate, we've all heard about hard money loans. It's an asset-based loan. You've got to go out there. The person's going to underwrite the deal and say, okay, I'm going to check your ARV. I'm going to check your remodel costs. I'm going to check the value of the property as is. And I need you to put a bunch of money on escrow with me, and we're going to hold that. And essentially, we're going to babysit this entire project. But what I'm hearing is that this is a likely much simpler process. I go to the life insurance company and say, hey, I need to borrow $100,000 of my $100,000. They give me a loan. They give me a note, or they get a note. And my money still stays there with the life insurance company, but now I've got another $100,000 in my pocket, and I can go out and buy that house with no inspections, no due diligence from someone else. It's my deal. I can do it however I want to do it, and that's a much more simplified process. Does that make sense? Is that correct?
Yeah. Here's the beauty of it is that not only do you get that flexibility and that autonomy to do that, but you also at the same time still have your cash on deposit at the insurance company earning somewhere between 3 to 5% after tax, after insurance costs, protected from creditors. People don't know this exists. This isn't a reportable item. We start getting just a little extra benefits. Daniel, would you like to know who the largest purchasers of this stuff is?
I would most definitely like to know.
The banks themselves.
Yeah.
Does that shock you? So Joey used to work at Wells Fargo Bank.
Uh-huh.
They have $18 billion
With a B.
in cash value. 18 billion. That's crazy, isn't it?
That's like the max they can keep in their tier 1 assets under this type of asset.
I try to do the same thing with my bank. No more than 18
Yeah,
billion.
well,
at
I
one time.
mean, we all are trying to get there, right? Just a few zeros shy of that. But it only goes to make sense, right? Because they understand lending. They know what they want to do. But at the same time, they need a safe place to put their capital. And they're doing this. Now, the government, as Joey was saying, limits how much money they can put in life insurance. And so that's the reason they only have 18 billion and not more. But if you go and look at that asset class, and speaking of real estate, by the way, we all know the 3 keys to real estate: location, 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 especially when you're in that kind of business. Would you know if you added up all the real estate, all the bank buildings that Wells Fargo owns across the nation, it's less than their $18 billion in cash value.
Woohoo!
That's pretty interesting.
Pretty shocking.
So I need to take a moment and tell everybody watching right now to give a huge shout out and thank you to all of the guys that are on here. But also I'd like to personally give a thank you to Clint, who has been doing a great job of helping us answer some questions here. So I've got Clint over here on the Facebook group, and he's been helping answer a lot of questions for people. So thank him. But Joey, Russ, I need to get a huge thank you for all of y'all out there, because I can see everybody's minds going crazy over here in the comments. Go ahead and show these guys some love. Show them how much you're appreciating them. Make sure that you go out there, you download their app, Wealth Without Wall Street. Go check out their website and all that, because these guys really are opening up some serious concepts that you may not have ever even heard of before. And with that being said, I've got some more questions on this, like on the whole life policy. Like, if I'm going to go out there and I'm going to start shopping for one right now, what are some of the key things that I need to be paying attention to as a middle-aged man that's overweight with extremely high blood pressure?
Are you speaking for a friend or?
I'm speaking for myself. I ain't ashamed of it. My blood pressure stays around 175 over 115, so I might be able to get $1 out of a policy.
Okay. Well, so let's talk some basics here, right? So what we're talking about is an expert tool, but we're also talking about a tool that can be bought anywhere, right? And there's a lot of people that can buy real estate, but it also can be bought incorrectly.
Okay.
And so if we're going to help you make avoid some of those mistakes, right? The old adage, you can borrow information or you can pay retail for it. And what we would say, we actually just recently did a podcast on this not too long ago. We talked about How do you get started? Was that the name of the podcast?
That's
It was
right.
About
Yeah, it
two
was like
episodes ago,
2
maybe
weeks
on
ago,
our
yeah.
Wealth About Wall Street podcast. And inside of that, actually, Nelson Nash talked about the person coaching you, helping you buy the insurance policy is probably the most important thing of it.
Okay.
Because I'm sorry.
I said I was just saying okay.
Agreeing
Okay.
with you. Yeah.
So if without expert coaching, you will probably end up with something that you don't want. So a couple of things that you want to be looking for. You want to be looking for someone who understands this. So I would always say, make them show you what they're doing themselves. And this takes me back to when I was a financial advisor. I can assure you that the financial advisor is working with customers, and the group I was with, we manage almost $1 billion in assets. And the people inside of that place had good hearts, but when things started going crazy, the first accounts they started transacting was their own. They were making decisions based upon their own investment accounts. And so I always tell people, if you're investing with somebody, you need to put your money where they're putting it, and when they move it, you need to say, "Tell me,"
Okay.
because they're always going to watch it better than you do. So when it comes to doing this stuff, you need to go and ask the person that you're working with to just show you what they're doing personally, because that's going to tell you what their knowledge base or their understanding of it is. Secondly, whenever you go to buy an insurance policy, you want to buy the most expensive one that you can possibly get. Now, I know that's going to probably confound some minds out there because we're taught to be Walmart shoppers and everything. We want to get the best deal we possibly can get. But in what we're dealing with, our objective is not to get the largest death benefit for the cheapest amount of money. We actually don't even care about the death benefit, even though I have more than $12 million in death benefit. I am literally trying to get the most expensive death benefit the insurance companies and the IRS will allow me to do. And that's because I want to put as much cash in these policies as I can, that the government will not say this is a tax loophole instead of an insurance policy. And there's some rules and regulations. And that's why it's important to make sure you only work with advisors who understand this, because you want to buy an insurance policy where you put $1 in and maybe in 15 years you got $2 in it, right? You want to be able to put $1 in and have access to as much of that dollar in year one as you possibly can. And to do that, we need to suppress the death benefit as low as they'll allow us to get it.
Okay.
What are some other things, Joey, that you'd start adding to the list I'm creating?
Well, I would say there's also a place where you could start your search if you want to. If you wanted to stay somebody local, you can go to the infinitebanking.org. There's a practitioner list. It's a place where people have gone through the training that have brought them through. Nelson Nash himself created, so that you know that they at least have a good foundation and understanding. But like Russ said, don't just stop there, okay? Just because someone has taken this doesn't mean that they're operating at the level that you will need. I mean, think about if you go to the gym and you stand next to this guy and he's got a big beer belly gut and he says, "Yeah, I'm going to coach you to be the best you." And you're like, "Dude, you weigh more than I do. You're in worse health than I am. How are you going to help me?" The same is true with this sort of concept. Is you need somebody that is very familiar to the point where they're doing things at a higher level, so that you can say, "Wait a minute, he's somebody, she's somebody that can help me get to my goals." The other thing that I would mention is I would try to steer clear of somebody that's like a solo person, okay? Because at the end of the day, if you're going to that person for coaching and they're the only person that you can go to, then what happens if that person's not there? For a number of different reasons. Maybe they've retired and moved on. Maybe they pass away. They're older than you, whatever the case may be. You need somebody that has a team concept so that you can have multiple ways to get answers when you need them. Because ultimately, this is your future. This is your growth of your own money. You need to have somebody there to help you. And the only thing I would add to it is you need to have consistent times of going back to that person. A lot of, unfortunately, because these are life insurance policies, they have annual dates that are kind of quote unquote reminders that, hey, by the way, you got to pay your premium. Let's just meet again. Well, if that's the time that you get together with your person is once a year, how healthy are you going to be if you work out one time a year, right? It's not going to go very well. So we need to have regular conversations, or at least regular opportunities for you to be coached. And this isn't for us to beat our own drum, but we've really taken this seriously. Our podcast is a way that you can get regular information. And the community, we actually have a specific community called the IBC Inner Circle, where you're getting coaching every single week from us. This is where you're consistently getting to ask questions and get feedback so that you know you're on the right track. And
it's very similar to the academy that you built, Daniel. You've got to see a little bit of it. We have a general section where we get people that interacting. A little over 2,000 people are in there. And then we have a tight core group that are really focused just on this specific subject matter. We do have a monthly cost, and that's really just to kind of keep out people that just want to go in there and cause havoc. We want people that are focused, that this is something they're interested in. We have several hundred people that are in that group. But like Joey said, our company, our expertise is focused on this one subject matter. We believe that this is, and this takes me back kind of really at the very beginning. A lot of times we get on podcasts, we like to share what this does. Infinite banking for me is just the opening. If anybody's ever watched The Matrix, I kind of consider as when you take the red pill, now the world is really been brought into full light for you, and you can see lots of other things. And that's what we keep hearing from the people that are doing this, is that this really just started their minds to thinking of things differently. When you have access to your money, it really becomes, oh, wow, lots of things now become more, accessible to me and possible.
So let me recap with two real quick questions.
Sure.
Okay. Now, knowing my health and my current medical conditions, I'm not 100% certain that I'm going to be able to go through and get one. Maybe I can, maybe I can't. But I can go out and get one for my wife or something like that, right?
That's right.
Okay. How do you suggest I open up this conversation with my wife when I want to get her 13 different life insurance policies out of nowhere?
All right. Well, let's first talk about this. So a second ago, I made the comment that real estate is location, location, location.
Uh-huh.
And we think about life insurance very similar, right? Of course, we want to insure the breadwinners of the family, because if they were to pass along, even though we're not focused on the death benefit side of this, if they were to pass along, then that usually is the funding mechanism, right? Your ability to do deals is to continue the future legacy of the family. Okay. Well, if for some reason you couldn't get insurance, which I'm going to tell you that's probably not an issue in most situations. Remember that traditional insurance is, okay, I want to buy $1 million worth of life insurance and I'm 170 over 115. So, man, and that's going to cost me, $2,000 a year. I'm just making up numbers. You never know what the numbers are. It's going to cost me $2,000 a year versus if my blood pressure was really in line and I was thin as a 2-iron, and I could buy it for $1,200, right? So it's like, oh, it cost me an extra $800. But for what Joey and I do, the person coming to us typically saying, hey, Russ, Joey, I want to put in $150,000 a year into this, or $5,000 a month, or you pick your numbers, right? We've got people putting in $200 a month all the way up to over $1 million a year. And what's the most cash that I can get back by putting that in? So ultimately, they're asking me, what's the smallest the death benefit is? And with that in line, if I go back to your example, if you have $25,000 and you want to put in this insurance policy and you're at bad health, well, you're just going to buy less death benefit because you're at more risk, right? Okay. But the cash value is actually probably going to be very similar to the person that looks like a 2-iron and, maybe they got a little bit higher death benefit, but the cash that they can access might actually be similar to yours.
Well, real life, this is exactly like this week, Daniel. I'm just going to share this with you. 10 years ago, I started my first policy designed like this, and I was in perfect health.
Okay.
Right?
Perfect is a stretch, by the way.
Yeah, I would say close to perfect. Okay. And I started actually 3 policies in the first year, all at the highest rating, right? And then now, fast forward about 4 or 5 years in, I got ulcerative colitis, sleep apnea, and all of a sudden my ratings went to standard. And even this week, I just applied for a new policy, 60,000 a year, and literally they said, "You're not standard anymore, Joey." And you know what I said? Well, that's terrible, except that I now just buy less death benefit than I would have for the same dollar. I get the same amount of cash value growth in my policy as I would have 10 years ago. I just now buy less death benefit for the same amount of premium.
So what you're saying,
all that being shared, I mean, I just want to let you know, this is real life. I'm living it. Russ is still in that perfect health thing, but whatever.
I'm the 2-iron in the group.
So what you're telling me, and I want to make sure I got this right, is that when you started down this path of infinite banking, you were in perfect health. And now that you're 7-8 years into it, it has absolutely destroyed your health?
I don't know. Maybe it's just since I've been working with Russ,
I'm going to say it's more of the donuts and the ice cream that he consumes, right? Because my health rating has not declined at all.
Okay.
But so to answer your question, I did want to make sure I address that, because sometimes we think in terms of traditional, typical insurance. And so we go, oh, well, we probably should want to buy it on the most healthy person. And that sometimes leads people to go, well, why don't I buy it on my 2 daughters, right? And or buy it on my wife, or buy it on my business partner. And all of those things are valid things. I own 21 insurance policies, and they are owned. I have 4 kids. I own actually 2 policies on each one of those. I have 3 different policies on my wife. I own 2 different policies on Joey. I own 1 policy on a former employee at my wife's dental practice, and we're in the process about to buy 2 insurance policies on 2 investment partners we're in. So you can have insurance policies on all different types of people. And if you wanted to buy it on your wife, you could. Remember, there is the death benefit part of it. I don't think any of us are willing to go to prison for the rest of our life to potentially, get $1 million. At least I'm not. So I hope our spouses would be cool with that. But also there are the protection measures, right? As we're building wealth, we need to protect wealth. And the best way to protect it and to pass it along is when we own life insurance. That's a great tool that is used in just that measure alone.
Okay. So I do have one final question, and excuse my ignorance on this. I'm gonna have to go through and learn some more of this myself. So we initially get this, let's say it's $2,000 a year. Let's just throw that out there as a number. At $2,000 a year, what is my immediate cash value benefit of this policy? Is it $2,000 once I've paid that $2,000 in, and then I've got to grow that $2,000 to $100,000? How does this work? How do we initially get that hypothetical $100,000 in cash value?
So it's going to work, again, that's a little bit backwards thinking than what we've always thought of as the protection vehicle of insurance. And so I'm going to back it into, we always start with, this is a very critical question to ask of a coach, okay? If you go to them and you say, I want to set up one of these policies, like an infinite banking policy, and they say, well, how much death benefit do you want? You're in the wrong place.
Okay.
Period. End of story. Don't even move on. They don't know what they're talking about, okay? Because we're always going to start with what is the amount that you want to start putting in? What is the deposit amount? And that always really comes back to, what are you dealing with in terms of cash flow? Okay. So you say, man, I want to do $100,000 this year into this premium. Okay, great. When we set this up right, you're going to have anywhere between 60 to 80,000 of that 100,000 available immediately. Let's say you put it in all at one time, right? 100,000, write a check, bang. Within a few weeks, you have access to 60 to 80,000, depending on how we exactly set it up. Okay, immediately. The next year, you're going to put in another 100,000. And there's variations of this, but I'm just simplifying it. In that second year, you're going to have access to 75 to 85,000 of that 100,000 after you've paid that premium. In the third year, you're going to have access to 90 to 100,000 right away. So you're almost at break-even point of what you've put in that particular year.
So to answer your question too, I want to make sure we do this, but we always think about this as business owners. How quickly do we get to profitability in our business? How quick do we get to efficiency?
Right.
And the way that we design these insurance policies, Daniel, is usually year 3, sometimes year 4, we're putting $1 into our account that we want to use to go buy real estate. and we have $1 in that account from what we just put in that year available. Now, it may take us another 2 or 3 more years to get all the $7 that we put in equal $7. But really the game that we're playing is it's option A or option B. Option A is I can put it in my checking account, and then when I need it, I go take it out and I go buy real estate. That money's now gone, never to be there again. And it's only $1 that's in the account when I go to get it. And initially, when we start these insurance policies and put $1 in, as Joey said, I'm just going to pick a number in the middle. I got 75 cents to get out. And it's going to be, oh, I can't buy but 3/4 of what I could have bought if I just put the real dollar in. And for some people, that's a hang up and they just can't get past it.
Okay.
But we always say we're playing a life game here, because right now, just real life example, I'm 10 years into my oldest policy. Last year, I put $1 into that policy. When I say dollar, I put in $7,100. My cash available from that dollar that went in is now $14,800. So I put $1 in, and I got access to almost $2.05.
Okay.
So we're talking about the real estate game. When I put $1 into my account, if I can start taking $2 out to go buy the same real estate that my friend was going to put $1 in and only get $1 out, and I can do that for the rest of my life, and it keeps getting better, you can see I'm going to get to a position of success much quicker. And when I catch them, it may take me 6 or 7 years to catch up with them because of, buying a little less early on. But when I catch them, the race is over, because I'll overtake them, and I'll be so far out in front of them, it'll be like me and Joey in a foot race.
Why got to be me? Why got to be me?
Sorry, guys. All right, then you're growing that tax free, correct? Like you're not paying tax. You're not having to get taxed on this, right?
And there's so many little things. I mean, we use it for the protection measure and for the ability to access funds. But when you start throwing in the fact that we don't have to pay tax on the growth, and when we access those loans are tax free. We can pass this money down to our kids and our families and repeat this process so our kids don't have to reinvent the wheel down the road, and our grandchildren. I mean, we really can have some really fun with this. And I'm going to just encourage you, as you're listening to this, thank you, Daniel, for giving us the opportunity not only to be on this platform, but also to come into the academy and to put our Infinite Banking 101 course, which we tried our best to break it down in little bite-sized steps. So you're going to be able to go into the academy and watch all of this. You can come into our community app and get the same course. But man, wherever you are, we just really appreciate you taking time to listen to this concept. It's definitely one of those things that early on I struggled with for a lot of those reasons. One, the word life insurance, being an investment advisor, I didn't think that was a good idea. Secondly, when I put money in it, initially I didn't have all my money. But as time went on, I started seeing the impacts of what this was doing. And then I started looking at the smart people and businesses around me. And I said, you know what, if Bank of America has over $20 billion of cash value, and I know they got a lot of people working in those banks that are much smarter than I am and much smarter than I will ever consider to be. If they've already done the homework and they think it's worth putting that amount of money in, it's probably something I should be looking into doing myself. And it's been a huge blessing over the last 6 months. I mean, I can't tell you the amount of emails, text messages, phone calls we've had from clients just to say thank you for opening our eyes to this, because now they're outside of the Wall Street rat race and no longer worried about the ups and downs. Our insurance policies have gone up every single day during all this process. Every insurance company we work with has paid a dividend every single year for the last 100 to 150 years, depending on how old the company is. So this is something that is tried and true. It's not just a Johnny-come-lately idea, and it's been a real blessing. So thank you again, Daniel, for letting us share this information, both on your academy, but also today on the platform.
Awesome. Well, I got one question coming in from the Facebook group, and then I've got one follow-up question after that. And Marshall Hooper asks, and I'm not sure if you're familiar with these guys, so if you're not, just go ahead and say so. But he's asking, why do the Choose FL or FI guys hate whole life so much? I don't know if you know who they are or whatever, but it sounds like it's somebody that's championing against whole life insurance.
Yeah, I know what Choose FI is. So that's part of the FIRE movement, Choose Financial Independence. to be honest with you, I've not read their stance on it.
Okay.
I would say, hey, you know, one of the most popular financial people out there, Dave Ramsey, for example, is anti whole life insurance, and we actually did a video. You guys can go if you want to on YouTube. Why Dave Ramsey is wrong, Wealth Without Wall Street, and we actually did a 2-part series and just broke out like what actually Dave Ramsey said about life insurance in general, and we took all the opinion. Maybe I threw a little bit of subject matter in there, but for the most part, I just used his article that he wrote or someone wrote for him and just broke out the numbers just to prove, you know, we're talking about apples and, you know, astronauts kind of thing. I mean, so I would say most of the time it's a lack of information, right? That we're talking about completely different things.
And I would say this, Marshall, if you are in any way, shape, or form connected to those guys, we welcome the opportunity to actually go on platforms like that and just be a resource that they can ask their questions to directly if they're open to it. In fact, we've had a number of people that came on with this very adverse idea of whole life insurance and infinite banking and all this, and they just interview us and they ask us their questions. And by the end of those conversations, if they are open-minded enough to actually consider real numbers and real facts, it is a drastic difference. When they get off the phone with us or off the podcast or whatever it may be, 9 times out of 10, we're actually doing applications for them to do their own policies with us because they don't understand what they don't understand. And they're just regurgitating information that they've heard from the Dave Ramseys and the Susie Ormans who really don't understand or care to take this in. It doesn't corroborate with their overall, you know, message that they've been speaking for 20 years.
Awesome. All right. So apparently Marshall did bring this up in their group and got lit up. Like they just lit him up. So Matt, that might be a good place for y'all to start on a podcast. I'd love to see.
Please,
that
yeah.
debate,
Have him set it up. I'm all over that.
So you hear that, Marshall? If you can get this set up, these guys would likely go over there and educate some people. So let's see what we can do.
Let us redeem you, Marshall.
Hey, I will say, so we just real quickly on that. So we have some clients that are in a group called the Land Geek. I don't know if you guys are familiar with that group, but they were going to this boot camp every quarter, and they would start asking the guy Mark Podolsky, like, well, why are you guys not doing infinite banking? They're like, oh, no. And I mean, they would come back and it was just like little puppies just got their just nose smacked. And so Joey and I was like, well, why don't we get him on the podcast and why don't we talk to him about it? And he was like, well, why don't you guys come on mine and let me just pound questions at you guys? Because to be honest, I don't know anything about it, but I don't think it's good. And that was exactly what Joey said. If you go listen to the latest podcast we did with him, he and Scott Todd, the podcast co-host, they were asking us, they were just trying to hammer us at every point. And at the end, Mark Podolsky's response was, dang, why isn't everybody doing this? so it just really, most of the time, it's just lack of information.
Yeah, misinformation.
I really feel like it's a very poor mindset to take such a solid stance against something that you know nothing about. Like if you know nothing about something and then you want to hold on to a belief based upon no facts other than your own opinions, I consider that to be a very poor mindset that needs to be overcame. But I do have one final question for y'all, and we are getting to wrapping this up. What is it that Wealth Without Wall Street can do for this community? What is it that y'all can help people with? Where is it that Wealth Without Wall Street can provide value to some of these people that are watching today?
Yeah, well, man, I really appreciate that question. What amazing just opportunity you give us through that question. I would say first and foremost, we look at ourselves as an education platform, just similar to you. I know you love to give. You've talked about that in our conversations, and there's a lot of people out there that love to take. And Joey and I, we're blessed to be able to sit on these sort of podcasts and feel really abundant in the fact that if everyone listening here took this information, found somebody that was super qualified to do this that wasn't us, we would have feel like this was still a success. Now, of course, you know, we do share and teach this concept. We've built a whole team that works with people all across the country. So we have a platform that allows people to learn in. So I would say what things that we can do is we can offer community to somebody who's trying to learn this, because most of the people out there, unfortunately, are lone wolves. They're the Lone Ranger trying to figure out this by themselves, and that's a tough place. And we've seen people who've started this and tried to go be a convert to their friends, and got like that puppy, got their nose smacked, and really was wondering, are they doing the right thing? Well, we've built a community that allows people to come in, and they have hundreds, if not thousands of people in there that are doing this and are doing this successfully. So that would be one of the areas I think not only could we potentially help them structure the insurance policies and be their personal coach, but even without that, we could still be a community that helps support them and helps give them the little tools and nuggets that they need along the way to keep pointing back. Because really, we're just the means. Like, Daniel, what you're teaching people through real estate is the path toward financial freedom, right? You're teaching different methods and opening up your platform so other methods can be taught of how people can create cash flows. Those cash flows become greater than their monthly expenses. That's how they become financially free. They have to buy those assets from some reservoir. And that's where infinite banking and whole life insurance steps in. It's just the part at the very beginning there that we help. We do have some courses that can help people strategically with taxes and budgeting and paying off debt and things that you really need to get right first before you go down any of those other roads. Sometimes people need to backtrack, circle back, and go back there. What else, Joey? What did I miss that would add to that list, if anything?
I think the thing that we love about Propelio is you guys are exposing people to all the different ways that they can create financial freedom through real estate. There's an abundance of information on your academy. And I think the same thing is true with infinite banking and what we do at Wealth Without Wall Street is we're about exposure. We're about bringing people to things that they never knew existed. And it starts with the infinite banking concept because that's, again, the means, it's the reservoir. But outside of that, we have people now telling us, man, if I had never heard about Wealth Without Wall Street, I wouldn't have these policies. I wouldn't have gone and started down this path of land flipping to where now 12 months later, my wife doesn't have to go back to work after having our third child. She's a nurse, and she has the option of staying home. We never would have had that had we not engaged with you.
Would have never went and bought ATM machines that now give me the ability to walk away from being a pilot making $300,000 a year because my cash flow coming in exceeds my expenses. Yeah. The guy yesterday I had a conversation with who now has built a private label business on Amazon and is selling organic bamboo sheets. I didn't even know that was a thing. But that's our platform, is to expose people to different ideas. And we believe infinite banking is the tool that makes all of those things start to come to light.
Awesome stuff, guys. So I really appreciate it. I've already got several people in the crowd asking, when are we going to have these guys back on again? So if y'all ever want to do this again, just let me know. I'm sure we can pull that off. But I really appreciate all that y'all have done today. I know we're a little past the hour, so I'm going to go ahead and give it a land the plane moment. For everybody out there watching right now, if y'all have not seen the new update on Propelio software, y'all definitely should go check out the new Propelio software released. You do now have access to everything you could ever want in real estate investing. You've got national MLS comps, national lead lists, access to 144 million public records from property records. You've got access to build your own website very simply, no technical experience required. You also get a professional email and a Driving for Dollars app, and we are continuously improving the product with more releases. So if you want a 14-day free trial, no credit card required, go check out Propelio.com. And if you have never experienced the Propelio Academy, a 100% free resource to up your education on real estate investing through actionable, step-by-step, detailed instructional videos, go check out the Propelio Academy, 100% free. I do appreciate you. I do appreciate all of y'all. And if y'all wouldn't mind, Joey, Russ, could y'all stick around for just a minute after this, and I'm going to land the plane?
Yeah, absolutely. Glad to.
All right, well, guys, thank y'all so much for being here. Go ahead and say your goodbyes, and we'll land the plane.
All right. Thank you so much for having us, Daniel. Thank you for listening. We really appreciate it.
Yeah. Thank you guys for investing in yourself, because the people that are listening to this right now are committed to a better person on the other side. So anyways, thank you for making time for us.
Much love, guys, and you'll have a good one.